In just 33 days, the stock market lost a third of its value. March 2020. The fastest crash in history. People were staring at their screens, watching their savings evaporate in real time. And almost everyone did the exact same thing. They sold, they pulled their money out, they ran. But a small group of people did the opposite. While everyone else was panic selling at the bottom, they were quietly buying. And a few months later, when the market had fully recovered, they were the ones who got richer. Here is the strange part. They didn't predict the crash. They didn't have some secret information. They weren't smarter than you. They just did the one thing your brain is screaming at you not to do. Quick thing before we go further. I am not a financial advisor, and this is not financial advice. This is about understanding how the game actually works. Because once you see it, you cannot unsee it. So let's start with the uncomfortable truth. The reason most people lose money in the market has almost nothing to do with intelligence. It has to do with behavior. There's a research firm called Dalbar that has studied this for decades. Every year they compare what the average investor actually earns to what the market itself returned. And every year, the average investor loses to the market. Not by a little. In 2023, the average stock investor earned 5.5% less than the S&P 500. Same market, same year. They just made less. Why? Because the market didn't beat them. Their own emotions did. Here's how it happens. When prices are high and everyone is euphoric, people feel safe, so they buy. When prices crash and everyone is terrified, people feel scared, so they sell. Buy high, sell low. Over and over, the exact opposite of what makes money. And this is not because people are dumb. It is because your brain is literally wired for it. Deep in your brain, there is a part whose only job is to keep you alive. When it senses danger, it hijacks you. It floods you with fear and it demands one thing. Make the pain stop. And when you're watching your money disappear, selling makes the pain stop. It feels like relief. It feels like safety. There is also a second force at work, and it is even older. The herd. For most of human history, if the whole tribe suddenly started running, the ones who stopped to ask why got eaten. So we are built to follow the crowd. When everyone around us is panicking, standing still feels insane. Selling feels like survival. So the average investor isn't broken. They are just running ancient software in a game it was never designed for. In the wild, running from danger keeps you alive. In the market, running from danger is how you lose. Now here's the question that matters. If 99% of people are wired to panic, what is that 1% actually seeing that the rest are not? Let me show you. When smart money looks at a market crash, they do not see danger. They see a sale. Think about it like this. If your favorite store suddenly marked everything down 50%, you would be thrilled. You would back up the truck. But when the stock market goes on sale, when great companies suddenly cost half as much, people do the opposite. They run for the exit. The one time everything is cheap is the one time nobody wants to buy. The most famous investor alive built his entire fortune on this idea. Warren Buffett has one rule he repeats more than any other. Be fearful when others are greedy and greedy when others are fearful. And he does not just say it. He does it. Go back to 2008. The financial system was collapsing. Banks were failing. The market was in free fall, eventually dropping 57%. It felt like the end of the world. And what was Buffett doing? In late September, he handed Goldman Sachs $5 billion. Then, on October 16th, right in the middle of the panic, he published an article in the New York Times with a title that said it all. Buy American. I am. While the world was screaming sell, he wrote in plain view, that he was buying, everyone thought he was crazy. A few years later, the market had not just recovered, it had soared. And those crisis bets became some of the most profitable trades of his life. Now, why does this actually work? It is not magic. and it is not just courage. There is a real mechanic underneath it. When panic hits, people are not selling because the companies suddenly became worthless. They are selling because they are scared or because they are forced to. When markets crash, a lot of big players have to sell no matter what. They have loans to pay back. They have customers pulling money out. They have rules that force them to dump assets. So they sell everything, good and bad, at any price they can get. And that is the key. In a panic, the price of a thing and the value of a thing come apart. A wonderful business does not become a terrible business in 33 days. But its price can still get cut in half, simply because everyone is rushing for the door at the same time. Smart money knows the difference between price and value. Panic is the moment that gap gets the widest. And a wide gap between price and value is exactly where money is made. But here's the part that separates the winners from everyone else, and it is not what you think. They are not braver than you. They just decided in advance this is the real secret. The average person makes their most important money decision in the worst possible moment. In the middle of a crash, with their heart pounding and their screen bleeding red. Of course they panic. Nobody makes good decisions in that state. Smart money does the opposite. They decide what they will do before the storm hits. They keep cash ready on purpose, not because they predicted the crash, but because they know one will always come eventually. So when everyone else is frozen in fear, they are not making an emotional decision at all. They are just following a plan they wrote when they were calm. The panic that paralyzes everyone else is the exact moment their plan tells them to act. That is the whole difference, not IQ, not information. A plan made in calm, followed in chaos. So what does all of this actually mean for you, even if you never try to time a single crash? 3 things. 1. Panic is a signal, not a command. When you feel that urge to sell everything because the world is ending, recognize it for what it is. That is your ancient survival brain talking, not your rational mind. The feeling is real. But it is pointing you exactly the wrong way. The moment it feels most unbearable to hold is usually the worst possible moment to sell. 2. Make your decisions before you need them. You cannot think clearly in a crash, nobody can. So decide now, while things are calm, how you will act when they are not. Write the plan when your heart rate is normal and follow it when it is not. That single habit puts you ahead of almost everyone. 3. Time in the market beats timing the market. You do not need to catch the exact bottom. History is brutally clear on this. Every single crash so far has eventually recovered. In 2020, the market fell 34% and was back to new highs by August. In 2008, it fell 57% and went on to more than triple. The people who lost forever were not the ones who lived through the crash. They were the ones who sold during it and never got back in. So go back to where we started. A market falling apart. Everyone running for the door, and a quiet few walking calmly in the other direction. The difference was never a crystal ball. It was never nerves of steel. It was understanding one simple truth that the panicking crowd forgets every single time. Prices are set by emotion in the short run, but value wins in the long run. And the best opportunities almost always show up wearing a disguise. They look like disasters. Now you have started to see it too. I'm Buck. I'll see you in the next one.